Imagine scrolling through TikTok or YouTube and seeing another 20-year-old claiming they made $100,000 in a single month selling products online. The video usually follows the same pattern. A few screenshots of Shopify sales, a luxury car in the background, a laptop on a beach. Then comes the promise that anyone can do the same thing with only a few $100s and a Wi-Fi connection. It sounds like one of the greatest business opportunities ever created. And in many ways, e-commerce really has changed how people build businesses. Every year, trillions of dollars are spent online, and millions of customers buy products without ever walking into a physical store. But there's one question that almost every beginner forgets to ask. If building an online store is really this easy, why do most of them fail within their first year?
Welcome to
Why do
Lesson
so many
1
people
for
lose
beginners.
money, even though
Simply
they follow
copy
the
these
exact
steps to
same
succeed.
tutorials everyone else is watching? To answer that question, you first have to understand what business you're actually getting into, because despite what social media often suggests, e-commerce and dropshipping are not the same thing. E-commerce is simply the process of buying and selling products over the internet. That's it. Every time you order something from Amazon, Nike, Apple, Walmart, or even a small local business with its own website, you're taking part in e-commerce. The product could be clothing, electronics, furniture, pet supplies, cosmetics, or even digital products like software and online courses. As long as the customer places an order online, it's considered e-commerce. Today, this industry has become one of the largest in the world because online shopping is often faster, more convenient, and gives customers access to products from almost any country. But here's something many beginners don't realize. E-commerce is an industry, not a business model. Inside that industry are many different ways to sell products. Some companies manufacture their own products. Others buy inventory in bulk and store it in warehouses. Many businesses use Amazon FBA, where Amazon stores and ships products for them. And then there's the business model that became famous through social media dropshipping. Dropshipping is not a different industry. It's simply one way of fulfilling customer orders. Imagine you own an online store selling desk lamps. A customer visits your website and buys one for $50. In a traditional business, you would already have that lamp sitting in your warehouse. You would package it yourself and send it to the customer. But in a dropshipping business, you never own the inventory. As soon as the customer pays, the order is automatically sent to your supplier. The supplier already has the product, packs it in their warehouse, and ships it directly to your customer. Your job is to build the website, attract customers, answer their questions, and create a brand people trust. The supplier handles the inventory and shipping while you earn the difference between your selling price and the supplier's cost. This system dramatically reduces the amount of money needed to start because you don't have to spend thousands of dollars filling a warehouse before you even know whether customers want your product. That sounds like a huge advantage, and it is. Instead of risking $10,000 or $20,000 on inventory that might never sell, you can test different products with far less money. If one product doesn't perform well, you simply remove it from your website and try another. That's exactly why dropshipping became so popular. It lowered the barrier to entry and allowed almost anyone with a laptop to launch an online business. But the same thing that makes it attractive also creates its biggest weakness. Since it's easy for you to start, it's also easy for everyone else. Every day, thousands of new stores appear, selling nearly identical products from the exact same suppliers. Many use the same product photos, the same descriptions, and sometimes even copy each other's advertisements. Suddenly, you're not competing with one or two businesses. You're competing with hundreds, or even thousands, of stores trying to convince the same customer to buy the same product. This is where the idea of a winning product comes from. A winning product is simply a product that solves a clear problem, catches attention quickly, and has enough demand that people are willing to buy it without thinking for weeks. For example, products that save time, reduce effort, improve comfort, or create a strong emotional reaction often perform much better than random everyday items. But finding a winning product isn't as easy as copying what someone else is already selling. By the time a product becomes popular on social media, thousands of other stores have already launched it. Competition increases, advertising becomes more expensive, and profit margins become smaller. Successful sellers spend hours researching market trends, studying customer reviews, analyzing competitors, and testing different ideas before they find something that consistently sells. In many cases, the product itself isn't even the biggest reason customers choose one store over another. The biggest difference is trust. Think about companies like Apple or Nike. They don't always sell the cheapest products, yet millions of people happily pay more because they trust the brand. Online shopping works exactly the same way. Customers can't touch the product before buying it. They can't inspect its quality or speak to a salesperson face-to-face. Their decision is based almost entirely on your website, your product images, customer reviews, return policy, delivery promise, and overall branding. A professional website with clear information immediately feels more trustworthy than a poorly designed store filled with spelling mistakes and copied product descriptions. That's why experienced entrepreneurs stop thinking like dropshippers and start thinking like brand builders. They know products come and go, but a trusted brand can continue selling for years. Of course, building an online store isn't completely free. Even before your first sale, you'll likely pay for a domain name, a Shopify subscription, or another e-commerce platform, premium website themes or apps, product research tools, payment processing fees, and professional creatives such as product photos or video advertisements. You'll also need payment gateways like Stripe or PayPal where available, or alternative payment solutions depending on your country. In many regions, business registration and tax rules may also apply as your business grows. These costs may seem small individually, but together they quickly add up. And surprisingly, none of them are usually the biggest expense. The biggest expense is something almost every successful online business depends on: marketing. Building a beautiful website means nothing if nobody knows it exists. Unlike Amazon, where customers are already searching for products, your own online store has no traffic on day one. You have to bring people there yourself. That's why businesses spend money on Facebook ads, Instagram ads, TikTok ads, Google ads, influencer marketing, email campaigns, and content creation. In reality, you're not simply selling products, you're buying attention first and hoping enough of that attention turns into paying customers. And that's where this business becomes far more complicated than most YouTube videos make it seem. Because once advertising enters the picture, every click costs money, every mistake becomes expensive, and every sale has to cover far more than just the cost of the product. In Part 2, we'll follow a real customer order from start to finish, calculate exactly where every dollar goes, examine real profit and loss, explain why many beginners lose money despite making sales, and answer the biggest question of all: can e-commerce and dropshipping still make someone a millionaire in 2026, or has the game completely changed? Now, let's follow what actually happens after someone clicks the Buy Now button on your website. Imagine you're selling a portable blender for $60. A customer sees your advertisement on Instagram, likes the product, visits your website, and places an order. At first glance, it looks like you've just made $60. That's exactly how many beginners think about the business. They look at their Shopify dashboard showing sales and immediately imagine that money belongs to them. But in reality, that $60 starts getting divided almost immediately, and every piece of the business takes its share before you ever see a profit. The first expense is the product itself. Suppose your supplier charges $22 for the blender, including basic shipping. That money goes directly to the supplier because they're manufacturing, storing, packing, and delivering the product. Next comes payment processing. Whether you're using Stripe, PayPal, or another payment gateway, they charge a small percentage plus a fixed transaction fee for every payment they process. It may only be $2 or $3, but it reduces your profit on every order. Then there are platform costs. Shopify subscriptions, premium apps, email software, domain renewals, and other monthly services don't disappear just because you made a sale. They're fixed business expenses that continue every month, whether your store sells one product or 1,000. But the biggest cost, and the one that decides whether your business survives, is advertising. Unlike Amazon, customers don't magically discover your website. You have to pay to bring them there. Imagine you launch a Facebook advertising campaign with a budget of $100. Thousands of people might see your ad, but only a small percentage will actually click on it. This is where terms like CPC, CPA, and ROAS become incredibly important. CPC means cost per click, or how much you pay every time someone clicks your advertisement. CPA stands for cost per acquisition, which tells you how much money you spent to get one actual customer. ROAS means return on ad spend, showing how much revenue you earned compared to the amount you spent on advertising. These three numbers often determine whether your store grows or slowly runs out of cash. Imagine your advertisement reaches 20,000 people. 500 click the ad, but only 10 decide to buy the product. If you spent $100 on advertising to generate those 10 sales, your advertising cost is $10 per customer. Now let's do the math. Your customer paid $60. The supplier took $22. Advertising cost $10. Payment processing took around $2. After subtracting platform fees and other operating expenses, your actual profit may only be $20 or even less. Suddenly, that $60 sale doesn't look nearly as exciting. And if your advertisement performs poorly, your advertising cost might jump to $20 or $30 per customer. At that point, you could actually lose money while still making sales. That's one of the biggest surprises for beginners. Sales do not automatically mean profit. This is exactly why experienced e-commerce entrepreneurs spend so much time testing advertisements instead of simply launching one campaign and hoping for the best. They experiment with different videos, headlines, product images, audiences, and offers. Sometimes a small change, like rewriting the first sentence of an advertisement or improving the product video, can reduce advertising costs significantly. Other times, a campaign that looked promising on the first day completely stops working after a week because more competitors begin advertising the same product. The online advertising market changes constantly, and successful businesses have to adapt just as quickly. Even after you solve your advertising problems, new challenges begin to appear. Customers may request refunds because the product arrived damaged, shipping took longer than expected, or the item simply didn't meet their expectations. Some customers file chargebacks through their bank, claiming they never received the product or didn't authorize the purchase. Every chargeback can cost not only the refund itself, but also additional processing fees. If too many chargebacks happen, payment processors may even suspend your account, preventing you from accepting new orders. Then there are supplier issues. A supplier might suddenly increase prices, run out of inventory, send poor quality products, or delay shipments during busy seasons. Since you don't control manufacturing or shipping, your reputation depends heavily on someone else's performance. If the supplier makes mistakes, your customers usually blame your business, not the supplier. Cash flow creates another problem that many beginners never expect. Imagine your store suddenly receives 100 orders in a single day. On paper, it feels like a huge success. But before suppliers ship those products, you have to pay them. That means your business may need thousands of dollars available immediately, even though customers have already paid you. In some cases, payment processors temporarily hold your funds to reduce fraud risk, leaving new businesses with a serious cash flow problem. Ironically, growing too quickly without enough working capital can damage a business just as easily as having no sales at all. So why do most beginners fail? It's usually not because e-commerce stopped working. Most stores fail because their owners underestimate how difficult it is to build a real business. Some copy products that are already saturated. Others spend money on advertisements without understanding their numbers. Many ignore customer service, underestimate shipping times, or expect instant success after watching a few motivational videos. The reality is that successful e-commerce businesses operate much more like traditional companies than social media often suggests. They study financial reports, monitor advertising performance every day, negotiate with suppliers, improve customer experience, and constantly test new strategies. It's not passive income. It's a business that demands attention almost every single day. This is also why the biggest companies eventually move beyond basic dropshipping. Once they discover products that consistently sell, many begin ordering inventory in bulk, creating custom packaging, improving product quality, and building private label brands. Instead of selling the same product as everyone else, they create something customers recognize and remember. That's how businesses increase profit margins, improve delivery times, and build long-term customer loyalty. Dropshipping often becomes the starting point, not the final destination. It's a way to test demand with lower risk before investing in something much larger. So, can e-commerce and dropshipping still make someone a millionaire in 2026? The honest answer is yes, but probably not in the way social media makes it look. Million-dollar businesses still exist, and new ones are being created every year. However, they aren't built by uploading a random product, copying someone else's advertisement, and hoping sales appear overnight. They're built by understanding marketing, managing cash flow, building customer trust, solving real problems, and treating the business like a long-term company rather than a shortcut to quick money. The opportunity is still there, but the competition is smarter, customers have higher expectations, and success requires far more skill than it did years ago. The next time you see someone posting screenshots of massive Shopify sales, remember one important thing. Sales are only one number on the dashboard. They don't show advertising costs. They don't show refunds, chargebacks, supplier problems, taxes, software subscriptions, or sleepless nights spent fixing customer complaints. Behind every successful online store is a business that carefully manages dozens of moving parts every single day. E-commerce doesn't simply reward people who find the right product. It rewards people who understand customers better than their competitors and build businesses people trust. The website sells the product, but the business earns the customer. And in the long run, that's what creates real wealth.